Most investors and traders have a mistaken belief that they think buying more stocks or having lots of different trading positions all over the place can help them reduce investment risk and have a good diversification. However, these are just mistaken belief. It is just only partially true. Over-diversification can in fact reduce your overall return over the years. Hi, I'm Siwai Song. In this video, I'm going to share with you some of the important concepts about diversification in a simple manner for you to understand. By the end of this video, hopefully you will get some ideas about what diversification is and how much you need to do in order to have a good diversification and the 3 methods you can do to create a well-diversified portfolio. Click on the subscribe button and turn on the notification bell so you won't miss any of the informative trading videos we are producing for you in this channel to help you improve your game as a trader. So let's get started. Most traders and investors think that if they were to trade more products or to invest in almost everything in the market, they are able to create a diversification. However, in real life, because your money is limited, we have very limited resources in order to put our money in. So this is where we are unable to buy almost everything in the market. So imagine this, what would happen if you were to diversify in your money? If you were to diversify too much, will your return diminish or will your return reduce? And if you were to diversify too little, will you still be able to enjoy the benefits of diversification to minimize your risk? Now, before we look into how to do diversification, let's look at what are the things or what are the investment products that we can put our money in order to diversify our portfolio. We have stocks, we have bonds, we have futures, options, cryptocurrencies, we have REITs, which is the real estate investment trust, exchange traded funds, we have collective funds like mutual funds, hedge funds, a little bit more riskier collective funds would be private equities as well as venture capitals. And we can also put our money into physical assets such as property as well as business, and also we can put our money in investing in ourselves, which is our own education. Now let's get into the theory of diversification. In finance, there is one theory which is called the modern portfolio theory, and this is developed by Harry Markowitz in the early 1950s, and later on he won the Nobel Prize in Economic Science in 1990. So this modern portfolio theory, it highlights out how much you can invest in order to create a well-diversified portfolio. So let me explain this to you in simple words. Now here it is a x-axis which represents the number of stocks in a portfolio, and here the y-axis which is the standard deviation of your portfolio return, or in other words your portfolio risk. And there is another line here which you need to understand, which is this blue line. And what does this blue line means is your portfolio, your overall portfolio risk. Now let's begin by point A first. So assuming point A, where you were to just only invest in one stocks or just only in one position, and this point A would be your total portfolio risk. However, as you increase the number of stocks in your portfolio, or if you were to increase the position in your portfolio to point B, where point A, for example, you only invest in one stocks. Point B, you increase your position into 5 stocks, for example, your risk would reduce by a lot as compared to just only investing in one position. And as you increase your position even further to point C, you can see that your total risk ultimately would reduce from point A to point C. So along this blue line is your total risk in your portfolio. And as you increase the number of stocks or the number of positions that you would want to invest, your risk would come down to a certain level until this flat blue line here. And this is the risk is what we call the undiversifiable risk. So what does undiversifiable risk here means is that no matter how much you increase the number of stocks in your portfolio, there are still risks that you are unable to diversify away because these are market risk. So in short, in simple words, is that when you increase the number of stocks, you will be able to reduce your investment risk to a certain level. If you don't understand this immediately, it's okay, because I'm going to use some examples to illustrate for you to understand this concept better. Now, let me give you an example. Let's compare two different portfolios where both of them are actually investing the same thing. The first portfolio is where it diversified among 100 different stocks, whereas the second portfolio is a concentrated portfolio with just only 5 different stocks. Now, let's imagine this scenario. If one of the stocks in the diversified portfolio doubles in price, the value of the entire portfolio will just only rise by just 1%. Similarly, the same stock in the concentrated portfolio, it will pushes the investor's net worth up to 20%. Now let's compare these two portfolios. In order for the diversified investor to achieve the same result as the concentrated investor of having a 20%, there are two methods that it can do in order to achieve the same results. The first method is where out of these 100 different stocks, at least he needs 20 stocks in order to double up in order to achieve 20%. Or otherwise, he needs to have a method 2, which is at least one of the stock must go up by 2000%. Now, let's look at how is this realistic in terms of application for you to do your investing. Is it easier for you to identify one stock that is likely to double in price, or whether is it easier for you to identify 20 stocks that are likely to double in price? If you were to diversify too much, it can actually suffocate your profits, and you need to do a lot of homework. For instance, in this example, you need to be able to identify 20 stocks to double in order to achieve the same result as the concentrated investor. Now, let's look at another scenario, which is still comparing the same two portfolios where we have a diversified portfolio as well as a focused portfolio. Now, the scenario is the opposite side when the market comes down. One of the stock comes down half in price for a diversified portfolio, where it actually only impacts your portfolio coming down by just only 0.5%. However, for a concentrated portfolio, if one of the stock falls by half in price, your whole portfolio will come down by 10%. So here we can see that if you were to have a very concentrated position, it can actually increase your risk. And what we can learn here is that with a concentrated position, your risk is higher, and of course your return will be higher as well. Now let's look at the implication here, where how easy for us to apply diversification in our real life practice. Is it easier for you to identify 100 stocks that is unlikely to fall in price, or whether is it easier for you to identify only 5 stocks that are unlikely to fall in price. So from today's example, I believe you have gotten your answer of how easy or how difficult for you to apply diversification in real life. Before we go into how much you need in order to create a well-diversified portfolio, first you need to acknowledge the advantages as well as the disadvantages of diversified as well as the focused concentrated portfolio, because when it comes to diversification, it has its own pros as well as cons. So how much should you diversify exactly? This line where left hand side is 100 stocks and right hand side is 5 stocks. According to the modern portfolio theory by Harry Markowitz, he find out that the optimal diversification for general investors as well as trader, around 20 to 15 stocks would be an optimal number for a person to create a well-diversified portfolio. So in other words, if you have more than 20, you may not be able to achieve the benefits from diversification. And if you have less than 15 positions, your portfolio may not be optimally diversified. So now that you have already learned what are the impact for a focused concentrated portfolio as well as the over-diversified portfolio, now let's look at what are the methods that you can do to diversify your portfolio. There are 3 methods that you can do in order to diversify your portfolio. So here I'm going to share with you the 3 general approaches how you can do to create a diversified portfolio. The first method is where you can diversify across different industries. So for example, if you were to invest in the stock market, you can split your positions into across different industries, because different industries, the correlation as well as the risk would be different as well. The second approach where you can diversify across different products. So other than just only putting your money in the stock market, you can also put your money across different asset classes or different products, such as in the commodity futures, bonds, fixed income funds, or even mutual funds. And the last method that you can diversify is where you can manage the weightage of how much you put into each position. In other words, you should put less weightage on a high risk position. And of course, it depends on your risk tolerance, whether how much risk you are able to take and whether you are satisfied with the return that you are going to achieve in the future. So in short, for starters, you need to focus on building your trading knowledge as well as your competencies. For starters, you do not need to jump straight right into learning how to diversify your portfolio yet, because as your wealth grew and as the available capital for you to invest increases, you will need to learn how to diversify your portfolio across the board properly, so that you can have a stability over your whole portfolio as well as your net worth. So that's it. I have shared with you the key concepts about diversification theory, and hopefully you have a clear understanding and broader picture of how to diversify your portfolio. If you find this video informative and useful to you, please share this video and give us a thumbs up. And don't forget to click on the subscribe button and turn on the notification bell. Until next time, this is CY Saw wishing you good luck and good trading.